Welcome back. It's now time for Your Money. We're joined, as always, by David Nelson, CEO of NelsonCorp. Welcome back, David.
Thank you. Thank you. Appreciate it.
Glad you're here, as always. And last week we discussed where we currently sit in the market cycle and the volatility that comes with it.
Sure.
Where is that at compared to what it was last year?
Well, slide one will kind of give us a feel for it, but kind of setting the tone. This year, the volatility has increased dramatically, as well as the returns have dropped. So a lot of noise here, but I'll try to decipher. This is 17. This is 18. What we see is these are daily moves as far as in the market. The S&P last year was up 19%. This year, it's basically flat as a pancake. Last year, we had 4 losses that were 1% or greater. This year, 24. Last year, we had a 2% or greater loss. We had 0. This year, we've had 10. And then the final number to look at here is the worst one-day return was negative 1.8. This year, 4%. So translation, basically what happens is that late in the market cycle, historically, what you're going to see is that the volatility is going to increase dramatically, which it has. And what that typically translates into is this cycle is coming closer and closer to an end. Volatility stays high, returns start dropping dramatically. Here we've gone an entire year basically where we're flat as a pancake.
So, I mean, where do we go from here? We know people can't really control market volatility. So what can they do in times like this when we're experiencing such volatility?
Slide 2 is terrific as far as to explain this concept. And basically what we're looking at here is we're going back to an old friend that we've looked at the last 2 weeks.
Yeah.
This is the S&P 500. We've had these big down moves, 49%, 100% up, 57% down, and 285% up. So we've got that as the benchmark, and what we're going to do is we're essentially going to create a portfolio that's 50% S&P and 50% cash. And what we find is that the drops are basically half, the increases are roughly half. And when we get to the end here, we started in both scenarios in 2000 with $100 deposited in. The fully deployed, so in other words, the average person out there thinks that they need to be deployed as far as in stocks at all time. That particular portfolio went from $100 to $173. So in other words, a 73% return in red. Now the 50% portfolio went to $194. So what we're trying to illustrate here is that people oftentimes will take a lot more risk than they need, and the assumption is by taking more risk that the returns are going to be greater. And what we look at here, 18 years, almost 19-year period of time, is that the returns were actually better having half your money deployed and the other half sitting in cash, which most people would never guess, but it's actually taken place.
There you go. Look at the numbers.
Yes, exactly. Exactly.
Perfect. David,
yes.
Thanks so much for joining
Appreciate it. You betcha.
Appreciate it as always. And if you missed any of this discussion, we'll make it available for you on our website, ourquadcities.com.